Good afternoon. Welcome to Midcap Radar. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormus Patakia. And these are the top stories that we're tracking this Tuesday afternoon, 1:30 p.m. Stocks swing up and down amid tariff uncertainties. Capital goods, energy eke out gains, while healthcare, FMCG drag. Midcaps fare better. Tata Tech slips more than 5% after nearly 4% equity worth 1,094 crore rupees change hands, while Sami Hotel surges 5% post a large trade of 87 lakh shares. Defense stocks extend their gains for the second day in a row as the India-Pakistan border tensions persist. Stocks like Cochin Shipyard, Garden Reach, Data Patterns all up between 10 to 13%. PNB Housing Finance rallies 8% after posting Q4 numbers. Net interest margins at a 6-quarter high. Gross NPA ratio at a 22-quarter low. Oberoi Realty, on the other hand, falls nearly 4% on weak numbers. Today's a quiet session after the more than 1% rally that we had yesterday. Today, markets are consolidating, but consolidating with a positive bias. We're up 37 points on the Nifty. Sensex up 186 points. Reliance, that's the big mover yet again. Reliance Industries has added 2.5% at a 4-month high. And in the last 2 days, Reliance Industries has added more than 8%. And IT has made a comeback too. Yesterday, IT was dragging, and today IT is positively contributing. Tech Mahindra 2.5% up. Infosys, HCL Tech, TCS up more than 1%. But that's the large cap action. This is Midcap Radar, so we need to find out the midcap movers. And Hormus is now at the big wall with all the midcaps that are moving around.
We just spoke about defense names, and we can't not talk about them because they are continuing from where they left off on Monday. Almost every single defense name is trading with gains of anywhere between 4% to as high as 13%. You look at Garden Reach is up 13, Data Patterns is up 13, Cochin Shipyard has moved into double digits as well, 10% higher there. Be it Mazagon Dock, be it Paras Defense, be it HL, all of them are trading with very healthy gains in today's trading session. Earnings reactions, of course, we are counting down to a lot of major earnings, but there are stocks that are reacting to those. UCO Bank is off the highs but still holding on to gains of around 4%, but not so good earnings reactions for stocks like AWL Agri, Oberoi Realty, TVS Motors, all of them at the lowest point of the day, down between 3 to 5%. The newsmakers of the day include the likes of Aurobindo Pharma, of the production stopping at its Andhra Pradesh facility, and that has had an impact on the stock. But the two other names that are in focus are Sami Hotels and Tata Technologies, both of them that had a block deal earlier in the day and are reacting to that. Volumes, stocks that are doing well on volumes. PNB Housing at one point was up 10%, but has cooled off. Whirlpool continues to gain, and it's up 30% this month on very strong volumes. India Cement is at the day's high, as is Shipping Corporation of India on very strong volumes. And some of the other gainers in the broader markets in today's trading session include the likes of TBO Tech. Sai Life Sciences is doing well, and Honasa Consumers finds its name at the list of gainers, 5.5% higher among the top movers in the broader markets. Reema.
Okay, that's a pretty exhaustive list. Lots of action in the broader markets today. Let's get into a break. As we do that, here is some good news. Network 18 is the #1 digital network in news and the information category as per Comscore report of March 2025. News18.com has 38% more users on native and social platforms, more than Times of India. As per, again, the Coms report of March 2025, Network 18 is way ahead of Times Internet with 55% more internet users on native and social platforms.
Welcome back, and on to corporate conversations. Then KFin Technologies is the next management on our radar. It was a weak quarter, but to discuss this and more, Vivek Mathur, the Chief Financial Officer of the company, is joining in on the show now. Vivek, good afternoon. Thank you for joining in. You reported a 30% top line growth in FY25, a 44% around about margins in FY25. So what are the targets that you have set for FY26? Because FY25 was a very different year. Markets were good, at least for the first half, but you're going to a completely different, volatile, uncertain market for FY26. So what are the targets that you have set for the new year?
Thanks for hosting me, Hormus. We believe that we will continue to grow at a pace of 18 to 20% on top line because we are a diversified company. We are not solely depend on domestic mutual fund business. About 64% of our revenue comes from domestic mutual fund. And as you said, market was quite supportive in FY25. And we believe that, the support will continue in coming quarters as well. But having said that, the other businesses have been outgrowing the growth in, the domestic mutual fund business. If you look at alternates or, which has grown at 76%. If you look at international business, that will continue to grow at 25-30%. And the new businesses that we are acquiring, which is the global fund administration business. Up till now, the international business was just about 5-6% of our total revenue. We believe it will grow to 15% of total revenue in the coming year. And we believe that margins will be in the range of 40 to 45%. And whatever we are doing in terms of acquisition is all through internal accruals. We are a zero debt company, so there is no interest on the books. And we believe we'll continue to do well in terms of generating free cash flow out of EBITDA, which will help us in terms of not only improving the operating leverage, but also maintaining our guidance of 40 to 45%.
So you're maintaining margins of 40-45%, but on the top line, you're talking about 18 to 22%. And that's a marked slowdown compared to what you did. Is this a conservative guidance? And FY26, X of the acquisition on an organic basis should be similar to FY25. It's just that you're being conservative right now. Or are you worried about the domestic, mutual fund business, which is still 2/3 of your revenues?
So, Riva, it has always been our guidance that we will go at 18 to 20% top line growth, while the mark-to-market gains is something which has helped us in FY25. And that is something which we believe will be range bound as the retail investors continue to remain invested. And we see, our SIP market share is still healthy at 39%. So we believe that, it is not a conservative estimate, but a realistic estimate of what we have been maintaining quarter after quarter. Whatever flows into the mark-to-market gains and that flows into the bottom line, we reinvest that to create future moats or to invest in future products or future geographies. And that's how the guidance remains at 18 to 20%.
But Vivek, even after this, your domestic mutual fund business, you mentioned that you are a diversified company. Yes, but still a majority of your business, almost 2/3 of it still comes from the domestic mutual fund business, right? And a lot of these asset management companies in their earnings call have mentioned that their SIP book has started to flatten off. Considering the market volatility, it might start to taper down further as well if the markets turn awry. So what does that do to your domestic business, and even as it still remains a core component of your top line?
So as I mentioned, 64% of our revenue is based on domestic mutual fund fee-based revenue. And if you look at within that, about 60% of revenue comes from equity AUM. So, if you can say about 40% of our revenue is dependent on how the market moves. So if there is a 10% reduction in the market movement, about 4% of the revenue will get impacted. So that is the, about 3.5 to 4% impact on revenue is the only impact that we will have. And other businesses like, issuer solutions, which is per folio per annum, and value-added services within mutual fund, which, almost 6% of the revenue, which comes from that. For the year gone past, overall VAS revenue has been 7%. If you look at alternate, that has been growing tremendously, about 70% plus. So, global fund services, which is based out of Southeast Asia, we have started winning large contracts. So, linked to market, the impact will not be huge. It will be range bound between 3.5 to 4%. And that's why our guidance that, we will continue to maintain good margins, a healthy yield, and top line growth, which will be in the range of 18 to 20%. We believe that domestic mutual fund should grow at a pace of about 14 to 15% organically without looking at mark-to-market abnormal gains. And that is what our guidance has always been, that, if there are mark-to-market gains, our EBITDA margin will be in the upper range of 45%, and that you have seen in the last quarter, but for the M&A spend of 12 crores, it would have been 46%. But if the markets are not so good, we maintain a guidance of 40%.
Got that. What was the market share gain last year in the SIP business? It now stands at 39%, but did you gain market share?
No, we haven't gained market share. It is in the same range as it was.
Oh.
So we haven't lost market share, but we have been steady.
What about international business margins? While on the whole, you're looking to maintain your blended margins, your international business margins are lower than the rest.
Yeah.
The reason for that, or do you have levers to improve it, especially now that you've got an acquisition of Ascent?
It's more to do with scale. International business is not at a scale at which the Indian businesses are. Indian businesses are at a gross EBITDA margin of about 55-60%, while the international GFS business is in the range of about 30%. So we believe that as we started winning new contracts backed by platform sale through Hexagram, or winning TA and FA clients, as we get into leveraging Ascent, the margins and the scale will improve. If you look at absolute yield in that business, it's more than 5 bips, vis-a-vis 3.6 bips in the domestic mutual fund in India. So yields are healthy. It's a matter of getting scale, which we are now started winning clients. It takes anywhere between 18 to 24 months in the RTA business in Southeast Asia to win a client, because it is captive business to outsourcing. We don't have competition in Southeast Asia, unlike what we have in India. It's easy to win against competition than to convince client to outsource. And that's why it takes time. But once you get it, you get a ready-made AMC with ready-made AUM. While if you win a new client in India, it takes anywhere between 5 to 7 years to have a meaningful corpus and start getting better yields, which will contribute to the overall margin.
All right, Vivek, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of KFin Technologies, the stock doing well for itself, 2.5% higher at 1271. Take a short break. On the other side, Samiran Chakrabarti of Citi joins us to discuss the latest RBI open market purchase announced last evening. Stay tuned.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.
Welcome back. I'm interrupting Midcap Radar because we want to understand the Reserve Bank's unexpected announcement of a massive OMO purchase of bonds, or rather open market operations purchase of bonds, which they announced late Monday evening. The Reserve Bank said it will buy 1.25 lakh crore of bonds between May 6th and May 19th. That is, when they buy bonds, they put in that kind of money into the interbank market. The interbank market already has surplus liquidity, so this surprised a lot of market people to understand what the Reserve Bank is trying to achieve. I have with me Samiran Chakrabarti, Chief Economist at Citi India. Samiran, good morning, and thank you very much for joining in at short notice. Well, first of all, were you surprised by the announcement?
So, Lata, as things go, these OMO announcements have been much higher than where the market expectations have been. And I guess the primary reason behind this is that in earlier instances, the market was looking at different kinds of overnight rates and spreads of 3-month CD over overnight rates to understand whether there is liquidity stress in the system, or in other words, was looking at the price of liquidity to decide whether further liquidity infusion would be done by RBI or not. But now what appears to us is that the RBI has a certain quantum of liquidity target in their mind, and they are gradually building up through these OMO purchases towards that liquidity target, regardless of where the price indicators of liquidity in the market is. The overnight rates are already lower than the repo rate. The 3-month CD spread has collapsed almost 100 basis points from the highs about a month or so back. So that's not the primary reason for the OMO. The RBI is building towards that 1% of NDTL type of liquidity surplus as they move forward.
Okay, I take your point. Just to tell my lay viewers, the thrust of the Reserve Bank, according to Samiran, is that they're not anymore looking at the yield levels. Initially, bond guys used to look at the yield levels, and if it went higher than the repo rate or something in the call market, then you would expect Reserve Bank to intervene. Now the Reserve Bank is intervening, although the yield is below the repo rate. And as he sees it, that's because they want to keep the total amount of excess liquidity at 1% of total deposits, which is what NDTL means. But Samiran, therefore, what is their aim? Why would they want to keep that 1% NDTL? Is it for faster transmission of deposit rate cuts?
So it could be a mix of quite a few things. One possibility simply is that despite the significant OMOs that RBI has already done, the durable liquidity surplus still is lower than that 1% of NDTL. We think that number is somewhere close to the 2 trillion rupee mark rather than the 2.5 trillion rupee where probably that 1% of NDTL is. And the banking system liquidity surplus, the frictional liquidity is also not that big a surplus as yet. Now, the interesting thing is that in the month of May, the RBI is going to give a very large amount of dividends to the government, budgeted to be at least INR 2 trillion. That adds on to the durable liquidity, and at that point of time, the durable liquidity surplus would definitely cross that 1% of NDTL mark. Now, to what extent that injection of durable liquidity will be compensated by other types of absorptions of liquidity, whether in the form of higher currency in circulation, higher FX intervention, or for that matter, there's a large amount of FX forwards which are coming up for maturity. To what extent rollovers would happen or not happen on that front, everything will determine where the final durable liquidity is going to end up with. Our sense is that if the forwards, it's very difficult for us to estimate the forwards part, but without that, the durable liquidity surplus could end up closer to 5 trillion rupees is what our sense is. However, the banking system liquidity will not improve as quickly because it takes some time for government to use or spend this dividend that they will get from the RBI. But once the banking system liquidity improves, that's the time we will probably see more reaction on the deposit rate and the lending rate side. And there, I guess the main issue is that if the bond yields come down, then we have seen that with about a 6-month lag, the weighted average lending rate also comes down. Given how the bond yields have behaved in the past, our sense is that within the next few months, we should see the weighted average lending rate at below 9%.
Okay. Can you give us some idea, therefore, of where you expect the 10-year and the rupee to range over, say, the next 2 quarters?
So our sense is that right now there is a possibility that the 10-year comes below 630 also, which was our initial target taken long back. That's because the rate action as well as the liquidity action has been more than what we had anticipated at that point of time. However, we have to also be cognizant of the fact that in all earlier cycles, in the rate cutting cycle, typically the term spread, the spread between the 10-year bond yield and the policy rate, that widens further. So that's why the bulk of the reaction from future rate cuts, we think that at least 50 basis point of more rate cuts could be there. That could be more at the short end of the curve rather than at the long end of the curve. Although we have to see which particular segments the OMOs are happening to some extent, that might also impact the yields. But overall, not expecting a major action at the long end, more action at the shorter end is what our sense is. And on rupee, I think it's a tussle between where the dollar is going versus where the CNY is going. But our sense is that at this point of time, the bias is towards a very marginal depreciation, but a more range-bound rupee movement because inflation differential is collapsing quite significantly for India. And the fact that we have now built up substantial reserves as well, our ability to keep the rupee in a relatively narrow range is much better now.
Okay, a very quick last question, and it's more academic really. There is one part of the bankers who feel that because they have RBI has $80 billion of forward sell positions, buy sell positions, and maybe a large part of it is maturing. That is why this money. And there is the other one who was saying what you are saying, that there will be cash withdrawal and there will be CRR money going away. What do you think is the reason? Is it more the FX reason or is it more cash withdrawal, CIC and other reasons?
So obviously, as I was saying, that without the forwards position, the durable liquidity would end up close to 5 trillion rupees by end of the quarter. So it's possible that the actual increase will not be that much because of some forward positions being also extinguished. But it's very difficult to take a call that how much RBI will go on this front. But there is room for RBI to take this approach because the overall durable liquidity surplus is going to be so much that they would not be too concerned on that front. But I must say that it appears that the liquidity situation is being kept in line with the accommodative stance of the RBI's current monetary policy, which will make sure that the transmission of rate cuts are much faster.
Okay. Thank you very much, Samiran, for this unscheduled stop and explaining the policy to us. So there you are. It looks like the main thrust, as far as you and I are concerned, is that deposit rates should also fall as quickly as the repo rate is cut, which is obviously good news for banks and NBFCs.
Which shows the kind of moves that we've seen over the last couple of days as well, right? Lata, thanks a lot for that update. By the way, there's more updates on your screen. The second day of Ather's IPO subscribed around about 24% of the full issue. The retail portion is fully subscribed. The NII portion subscribed around 20%. The employee portion, though, subscribed almost 3 times the shares on offer. By the way, 24,350 is where the Nifty still continues to remain at, still struggling to cross last Friday's high. So meandering in a range as there is a tinge of caution that continues to persist on the street. But the defense stocks continues to move higher. Tata Technologies is at the lows of the day. Oberoi Realty 2 at the lows of the day. But with that, we call time on this edition of Midcap Radar. From Reema, me and the team that put this show together, thank you so much for watching. MF Corner on the other side.